So if you're wondering why most people are broke, you've come to the right place. I lived that life, so I know exactly what causes it. More importantly, I turned my financial life around by doing the exact opposite, and you can too. What follows are 10 reasons why most people are broke. And if you don't want to be like most people, all you have to do is avoid these financial mistakes. But before we get going, make sure to like this video and subscribe for more videos. Let's dive in. They don't have clearly defined financial goals. Financial objectives serve as the beginning point for any action you take with your money. In other words, setting financial goals directs your future financial decisions. They provide you with financial guidance as well as a sense of purpose. Furthermore, without them, your financial life would be unaccountable. For example, if you plan to save $10,000 this year, you must evaluate every spending decision you make between now and then in terms of whether it will assist or hinder your efforts to save $10,000. Honestly, a simple question like that can be the difference between impulse spending and frugal living. In fact, I would go as far to say that little questions like that can be the difference between being broke or wealthy. Quick tips for setting financial goals. Setting financial objectives is the first step if you don't want to be broke. Setting at least 2 achievement goals and 2 habit goals is recommended. But if you don't know what I'm talking about, let me explain. Goals with an end point are known as achievement goals. They are nearly often linked to a certain financial number in personal finance. Whether you want to save $10,000, as in our previous example, pay off all of your debt, or save for a down payment on a house, all of these goals have a finish line, a point at which you will have met your goal. Habit goals, on the other hand, have no end date. They are continuing, therefore consistency is the goal. A decent habit aim would be to invest 15% of your earnings every time you get paid. I will concede that habit goals are less thrilling than achievement goals, which makes them more difficult to maintain. As a result, I recommend that you match them with an achievement target. For example, if you established an achievement goal of investing $5,500 this year in a Roth IRA, you could match it with a habit goal of investing at least 20% of my income in retirement whenever I get paid. The habit goal will be continuing, but it will help you attain your achievement goal. Good examples of financial achievement goals. Save enough to pay cash for my next car. Get out of credit card debt. Pay off my house. Save enough money for a vacation in 6 months. Good examples of financial habit goals. Tithe 10% of my income. Invest at least 10% of my income, not including retirement, whenever I get paid. Read at least 1 book on personal finance every quarter. Log my expenses into my spending tracker every night. Have a weekly financial meeting with my spouse. They don't have a budget. One of the primary reasons most people are bankrupt is that they do not live on a budget. In fact, according to a recent U.S. bank research, only 41% of Americans stick to a budget. And how are you meant to know when you're slipping off track with your finances if you don't have a budget? Budgeting allows you to plan, track, and analyze your spending habits. It is your well-paved path to your financial goals. They don't track their spending. Most people are broke because they don't keep track of their spending. However, this completely violates the point of a budget. It's easy for money to slip through your fingers if you don't track your expenditures. Then, before you know it, you're broke and have no idea why. I like to compare expenditure tracking to parenting. What should a parent do when their small child wanders away? Keep an eye on them. The same is true for your money. Money has a propensity of wandering off if you don't pay close attention to your purchasing habits. You must keep track of your expenditures at the grocery store, retail outlets, and restaurants. Otherwise, you will find yourself wondering what happened to all that money you had. They use too many forms of payment. The more complicated your finances become, the more difficult personal finance becomes. If you'll humor me for a moment, imagine a world without credit cards or the ability to borrow money. everyone would have to pay cash for everything they want. Imagine how much easier your money would be. The more loans and credit cards you add to your financial picture, the more confusing it becomes. You soon find yourself spending money on 6 different credit cards, each with a different balance. Then, in order to pay for everything, you must log into various accounts. And because each account has a different interest rate and broadcasts transactions at different intervals, it's difficult to determine how much money you have and how much money you owe. It's a pretty sloppy method to manage your money, and it frequently leads to bad spending habits and financial mistakes. Meanwhile, if you just make transactions using a debit card, you can log into one account and see exactly how much money you have. This makes tracking your spending much easier and budgeting in general a more fun process. They carry credit card debt. It's no secret that credit card debt is a bad thing. It not only complicates your spending habits, as previously stated, but it also comes with the added gut punch of hefty interest rates. In fact, the interest rates are so high that unless you make a serious effort to pay them off, you may be in credit card debt for the rest of your life. Credit card debt is the deadliest adversary of financial success, and it is one of the primary reasons why so many individuals are bankrupt. They borrow money to purchase depreciating assets. Aside from credit card debt, most people go bankrupt because they borrow money to buy significant expenditures they cannot afford. Furthermore, most loans are used to purchase depreciating items such as automobiles, recreational vehicles, boats, and pretty much anything else with a motor. I'm no financial genius, but I believe that the key to riches is to do things that allow your money to grow, rather than pay someone extra for something that loses its value. They base their financial decisions on cash flow. One of the most common financial mistakes you can make is to base whether or not you can afford something on how much the monthly payment will be. For example, if you want to buy a new car, you can say, "I can afford the monthly payment, thus I can afford it." In the meantime, a wealthy perspective might be, "I can't afford this car since I can't pay for it in full." It's simple to become broke if you base your purchases on the cost of the monthly payments, whether there's interest or not. Why? Because you will eventually exhaust your money with monthly payments, and the worst thing is that you will be trapped into those payments for months, if not years. Buying based on cash flow and monthly payments is like gradually sending oneself to financial prison. They don't prepare for emergencies. According to a 2018 study from the Federal Reserve Board, nearly 1/3 of U.S. households would need to sell something or borrow money to cover a $400 emergency source. I'm not sure about you, but that sounds like a significant issue, especially when a $400 emergency isn't anything I'd consider unusual. In fact, I would consider that a minor emergency. Just one trip to the ER will show you what I'm talking about. You are setting yourself up for financial disaster if you do not plan for financial emergencies. And while medical emergencies are common, they are not the sole risk. What happens if your car breaks down? What happens if you lose your job? Worse, the less prepared you are, the more emergencies you may encounter. Do you not believe me? Consider the following scenario. There are 2 of them. The first person has $100 saved, whereas the second has $25,000 in an emergency fund. Now imagine that both of them inadvertently smash their phones, which they require for work, and are obliged to purchase new ones. I'm sure the first person would term it an emergency. Meanwhile, it was only a slight annoyance for the second person. They don't invest consistently. First and foremost, I believe it is critical that you recognize that saving money will not make you wealthy. To become wealthy, you must put your money to work, which requires regular investing over a lengthy period of time. In instance, do you know the difference between rich and poor people? Rich individuals earn interest while poor folks pay it. So, if you don't want to be broke, you need to do 2 things: avoid debt and invest. That way, instead of paying interest, you'll be earning it. they spend before they save. Another reason why most individuals are broke is that they spend their money before they save it. The ordinary person will take their salary, subtract their monthly costs, and then save and give whatever money is left over. The issue with this is that it prioritizes spending above conserving. This invariably results in a sluggish savings account and slow financial success. So, if you want to budget wisely and avoid typical budgeting blunders, reverse the financial process. Rather than prioritizing consumption, make giving and saving your top priorities. Simply said, give first, save second, and live off whatever money is left over. Last thoughts. The majority of people are broke because they make poor financial decisions. I know because I used to be one of those people who made bad financial judgments. So, if you find yourself in the same situation, it may be time to ask yourself some probing questions. Do you keep a budget and track your spending? Do you spend your time paying loan interest or earning it through investments? Would a $400 medical emergency necessitate a loan? The good news is that no one is forced to live in poverty. You have the ability to shape your own financial future. Turning your finances around requires only effort and smarter decision-making.